I'm joined here by a small panel of two today, comprising Mark Fielding, corporate tax partner at Moore Kingston Smith and lead partner of the real estate and construction team, and Grant Lewis, Moore Kingston Smith's head of VAT and indirect taxes, who knows more than a little about the ins and outs of real estate VAT and real estate in general. So thank you very much, Mark and Grant, for being here. So the format of today's webinar is going to be quite simple. I have a series of questions to fire at Mark and Grant aimed at pulling out the key points of the budget relevant to the real estate and construction sector, and what our clients and our contacts should be looking for and thinking about now that Mr. Sunak has made his announcements. And I imagine there's going to be a fair bit of interesting opinion expressed as well throughout all of this. So please feel free to ask questions via the chat function as we go, and predominantly we're going to pick those up at the end in a Q&A session, and perhaps if there's some really good ones, we'll pick them up as we go in the actual presentation. So without further ado, I think we are going to get started. So it was a little past 12:30 yesterday that the Chancellor stood up and started his announcement, and he spoke for almost an hour in his normal sympathetic and reassuring tones, letting us know that he's really thinking about the British public. And he had quite a lot to say. There was a fair bit of a self-backslapping about all the good work that the government have done through the pandemic. There was a lot of talk about how much money the government has been spending, and he went at pains to talk about how much of a challenge that is putting on the public finances. And one probably could have been forgiven that you would expect some fairly big tax hikes after he set such a scene. But in the end, actually, there wasn't that much in the way of tax coming out, which perhaps is a good thing, with probably corporation tax increase being the most significant. What we're going to talk about today is the highlights of that insofar as it relates to the real estate and construction sector. Mark, you've been paying close attention to these annual budgets for some years now, digesting them, advising clients on them. Before we get into the real estate specific stuff, can you just give an overall view of the budget this year and probably more relevant, the economic position that we find ourselves in? Over to you, Mark.
Thanks, Guy. Yes, yeah, I mean, firstly, apologies, there are no slides this morning, but I'm not sure slides are necessarily appropriate for what we want to talk about this morning. So as Guy said, yeah, I've been watching and commenting on the budget for more years than I haven't, unfortunately. And I think, you know, it's stating the blindingly obvious that yesterday's budget was probably one of the most interesting, if that's the right word, for forever, as far as I'm concerned. Nobody on this call, and I suspect most people like me are listening or doing this webinar from home. Nobody's going to be immune to what's happened over the last 12 months. The Chancellor wasn't joking when he said that the level of spend that we as a country have undertaken over the last 12 months has never been eclipsed apart from during the height of the Second World War. With that background, it's probably appropriate just to quickly, and apologies if this is knowledge that everybody already has. It's probably not a bad thing just to talk about the economy more widely, and perhaps some of the key indicators and measures, and why perhaps there weren't any tax rises mentioned yesterday. So historically, the UK has run a budget deficit of around 3 to 4%. So that's the difference basically between what we collect in taxes and other investment as a government and what we spend it on. Generally, tax collections have been around the sort of 800 billion mark. So some of these numbers are quite big, obviously. And we spend roughly the same. Now, in the announcements yesterday, we got an indication of what the budget deficit is likely to be for 2021. And that is a significant increase on that previous historic average. Spending for 2021 looks like it will be over £1 trillion. Tax collections circa 800 billion. So in terms of deficit percentage, it's gone through the roof. And, again, no surprises, but that is a significant uptick in where it has ever been in the past. It's worth observing that the spend on coronavirus support generally across the country has topped 400 billion. That's all had to come out of public coffers. There's no reserve that sits there to account for this. All of this money, or largely all of it, has to be borrowed. So then we look at things like GDP, which is down 10% on previous years. We talk about GDP in the UK of roughly, and I say roughly because it is a rough number, you can round it and the numbers get very big very quickly, but roughly about 2 trillion is our national domestic output. Balanced against that is now a national debt of circa nearly the same number, which again is a historic high. Why am I chatting about all of this? Well, the reason I think that there weren't any significant tax rises yesterday, and the reason that most, if not all of the discussion was around building back better, enhancing investment, growth, opportunities, etc., is that is our only option. And that probably sounds quite stark, but I think that is the reality. Our only option as a country, and we're not alone, most of the countries around the world are in this similar position, but we have been hit one of the hardest economically by the coronavirus. Our only option as a country is to grow our way out of the trouble that we're in. And by that, I mean, we need to present a continuing position of growth, of a rebounding economy, in order for us as a country to be able to continue to finance our debt levels. And when we talk, I know on the audience here, we've got a number of wholly real estate and construction people. A lot of you guys will very much better than I understand the levels of debt that you can put against an asset, how you've got to service it, your interest cover, all of that good stuff. Now, the country is no different. We have to present a position to our borrowers of the ability to repay. The second there is some doubt about that, and I mean systemic doubt, I don't mean daily wobbles. What happens to our interest rates? What happens to our bond yields? What happens when the Debt Management Office has to go out into the market and raise further debt to pay our interest or to refinance debt? That's when the wheels start to come off. So the numbers that we're talking about are so massive. My view is it's pointless touching tax too much. You've got to do some things. You've got to make those who are successful pay their fair share. And I think that follows the corporation tax hike yesterday. But bluntly, and doing anything to tax at the moment is dabbling around the edges. The only way out of this is growth. I'm not going to go through all of the detailed measures that were announced yesterday. We're going to do that in this sort of series of questions as we go forward. And I suspect by the time you're listening to this webinar, even if you're listening to it now live, you'll all have been all over the BBC, the FT, and looked at what all the measures are. So we're not going to do a slideshow of all of those, which you've already all read. One thing I would say before I stop talking is I would suggest, if you haven't, and I wouldn't normally recommend this because it's usually a relatively boring document, but the budget report yesterday, the document that supports the speech, is on the Treasury website. We'll probably send a link to it after this session. As I say, I wouldn't normally recommend reading it, but given where we are as an economy and given what's happened, it is actually pretty interesting. I say that as a tax person, so everything's relative to me. But I would recommend people read it. It'll give you a good understanding of where we are as a country, and yeah, I think it's a good document. Guy, that's me.
Thank you very much, Mark. That was a good overview of where we are, if a little bit of a bleak picture, but that is probably the real picture.
My speciality.
Indeed. You know, we have spent a lot of money on COVID, getting things through, and we really don't have much option but to borrow there. Like Mark, I have read some of the paperwork that's come out of the government, and it is quite interesting, far more than in previous years. But it does give you a real picture of where things are. And I think Mark's very much right. There's no way we can tax our way out of this situation. We have just got to grow to be able to get our way through things, which is probably why the government have announced so many measures that that encourage spending. That is what they need the British public and business to do. They need us to spend so that they can collect taxes through that way. Right, moving on. Let's talk about the housing market. So the government have consistently over the last few years shown a desire to keep the housing market afloat and have used legislation and taxation to do that. And this budget was no different. We've had for a number of months the £500,000 SDLT holiday, let's call it, which has drove transactions through the pandemic. And they've now extended that through to the 30th of June. And then rather than that being a cliff edge, which is what people were criticising them for the 31st of March deadline, they've decided to halve the holiday to £250,000 between July and September, and then return to the full rate, or sorry, the lower rate of 125k from October. And people such as myself are in the process of buying a house, but in no way are going to achieve a completion by 31st of March. Quite happy about that. They also launched the 95% mortgage guarantee scheme, which in theory makes it easier for first-time buyers who are struggling to save up for deposits of 10 or 15% to access the housing market and get on the ladder. However, the leader of the opposition wasn't particularly impressed by that particular measure. He claimed that it was just a rehash of a Cameron Osborne policy from 2013, which in his words did nothing but raise the prices of houses and make it harder for people to get onto the ladder. So the question is, what do we think about the government's policy towards the housing market and the likely effect it will have? Are their strategies good, or is the leader of opposition right and it's just going to make things harder? And I'm going to go to Mark first for that, and then I'm going to ask Grant for his input too. So over to you, Mark.
Good questions. Good questions. Yeah, so the SDLT holiday, I think the extension of that is a good thing. People haven't been able to, from a purely logistical and clinical perspective, people have not been able to access the market in the way that the government had thought they would be. So extending it into the period where, in theory, the restrictions on movement on gatherings are being lessened, it is probably a sound idea. SDLT overall, I can't stand. I think it's a disgusting tax. Or maybe that's putting it a little strongly, but it is ripe for reform. A bit disappointed not to see any indication of that as regards what was discussed yesterday. Mortgage holidays and encouraging people to get on the housing ladder, or helping people to get on the housing ladder. Yeah, I mean, it is the age-old thing in this country that it is deemed a good thing to own your own property, and getting on the housing ladder is really good and you must do it. My worry comes probably from a personal aversion to financial risk, in terms of the higher the percentage that people are able to borrow against these assets, given what's happened, given a slight movement in monumentally low interest rates would see major problems across the entire economy. I think you've got to be quite brave to put that forward as a policy, as a government, especially when you're underwriting it. Again, it goes back to the point of, if we don't have growth, if we don't have a strong bounce back, we have got pretty serious problems, because we're betting the house on that, so to speak.
Thank you, Mark. Garan, would you like to put anything in there from your own point of view?
Yeah, I think that, protecting the housing market, encouraging the housing market, whatever adjective you want to use, has been a sort of consistent point of UK governments for pretty much as long as I can remember. And certainly since the financial crash in sort of 08, getting first-time buyers into the market and enabling them to access funds to buy houses has been a consistent sort of policy level. I have some sympathy with Keir Starmer that when this has been tried before, what has essentially happened is that prices for, let's call them first-time buyer properties, have gone up, because obviously the stock is limited, and you can't, as everybody on this call will know, you can't build new houses or blocks of flats overnight. The time frame is too long. The UK is pretty unique in my experience. You know, I remember one of my friends who's American said that, you know, we're the only nation in the world who talk about house prices at dinner parties. Politically, it's a very important thing to do. What will be interesting is whether or not, perhaps, particularly in terms of the 95% guarantee, that is an incentive for some creative developments in perhaps commercial properties or retail properties, where their historic use may no longer be quite as in demand as it was prior to the pandemic. So, you know, will we see the reimagining of our city centres, as some columnists have suggested, with, you know, increased residential developments in former shopping centres, office blocks, what have you?
Indeed, the repurposing of those assets that aren't going to be used for the things that they're being currently used for is certainly probably one of the biggest things that's going to happen over the next few years, and potential solutions to the housing crisis of supply. Certainly, the government made it clear that they want to move us from a generation rent to a generation buy scenario, underpinning that very British king of our castle mentality that has built up over the course of time, which, you know, perhaps not unique to the UK, but certainly in other quarters of the world, people don't put as much emphasis on it. And as Grant said, you know, people don't necessarily talk about house prices in the same way that that we do in the UK. And there's perhaps an alternative point of view that maybe generation rent isn't such a bad thing, and actually owning your own home is not the be all and end all of life. So, but time will tell. I tend to think that the mortgage guarantee, given that it's making finance more available, is likely to push up prices again, because generally speaking, the availability of finance is what puts up prices. So, but hopefully it does have the desired effect, and hopefully it makes all those people who are struggling to get on the housing ladder that want to have a little bit better chance of getting there. Okay, moving on to one of the more interesting parts of the budget, and something that one might consider new that probably isn't as new as some of the younger amongst us, including myself, maybe think of it as, and that was free ports. So the Chancellor announced that there was 8 free ports going to be created across the country, including one in Thames, without necessarily indicating where in the Thames. We've touted around that the Isle of Sheppey might be on the cards there. And these free ports are going to have some tax breaks for putting buildings in there, and also they're going to have reduced planning. And when we looked into the detail of what the government was persuading, we saw that there was going to be enhanced 10% rate of structural and buildings allowance, an enhanced capital allowances rate of 100%, which doesn't sound that enhanced when you consider the super deduction that we'll talk about later. Full relief from stamp duty land tax, and that probably makes Mark happy, where there's a lack of interest in stamp duty. Full business rates relief, and employer national insurance contributions relief. So Grant, you're a man that knows a fair bit about free ports from your sort of cross-border work, looking at VAT and indirect taxes. And I'm sure you won't mind me saying, and maybe a little bit old enough to remember similar endeavours in the UK in the past.
I will happily admit to remembering them when we had them before, yes.
Indeed. So with that, all that experience, seeing how they work abroad, and also knowing actually we've tried this before and how did it work, how much of an attractive opportunity do you think free ports actually are to the real estate businesses in the next few years?
I mean, obviously this was a much trailed announcement. Going back to the Brexit debate, it was one of the sort of leaving the EU policies. We can have free ports now. The conveniently forgetting that we actually had free ports for quite a long time, up until 2012, albeit in a slightly different format to the ones the Chancellor is envisaging now. For my view is that free ports are a bit of a curate's egg. You can point around the world to some very successful free port developments in places like Singapore, for example, and in parts of Australia. But if you look at the free ports that exist in Europe, the largest free port in Europe in terms of the value of goods that go through it is probably the one in Geneva, which is used almost exclusively for storing works of art in a tax-free environment. Potentially, I think they can be engines for growth and development at a local level. So typically, and this reflects where the Chancellor has decided to locate the ones in England, you put these things in areas of relative economic deprivation, where there's quite a lot of brownfield sites that are open for development, and some opportunities to turn places like, for example, Redcar from a steel making town into something different. The extent to which they create new investment rather than simply move investment from location A to location B is one much debated by economists. From a construction perspective, I remember when free ports were around before, there were certainly opportunities to develop large commercial properties on brownfield sites, and there were some big incentives to do that, and we saw factories and storage facilities and distribution facilities being built within these areas. The take up on those properties was not universally successful. I think there's opportunities there for development if you can find the right tenants, but I'm not sure that they're the panacea that some believe. Certainly at a national level, how much new investment they attract, I don't know. But if you are the local mayor for Redcar, then it probably is a very good thing, because it gives you a selling point to convince somebody who perhaps would have made the investment anyway to make the investment in Redcar rather than making it in another location.
So do you think this is more about playing to the localities and trying
yes.
to...
I think this is part of the long-term sort of policy you've seen in the UK of successive governments, of trying to give businesses incentives to invest in certain locations. So we've seen, regional development grants. We've seen various other incentives for people to locate in areas which are seen as needing investment. And indeed, the same as the announcements about the creation of certain new government or quasi-governmental institutions in places like Leeds, and moving government departments from London to other locations. People on this call will have noticed that I have a slight Welsh accent. I can remember when the DVLC moved to Swansea many years ago, and it was being heralded as the creator of thousands and thousands of jobs, which it has done. It's created a large number of jobs. Those are not new jobs, they're jobs that would have existed anyway. They've just moved from London to Swansea.
So it's not necessarily the case that it's almost like a redistribution.
Yeah, I think that's exactly what.
In a different form.
I mean, I think, if some of them can be made into genuine Singaporean style free ports and can compete with the large container handling ports, particularly in Holland, that would be brilliant. But with a possible exception of the one in the Thames estuary, I'm not sure that any of them are located in the right places to do that.
So still a potential opportunity for developers if there was going to be works to be done.
Absolutely.
On the more macro economic scale of the country, really just redistributing jobs and redistributing where things go.
Yes, I think so. I mean, there may be clearly some overseas investors who are looking at perhaps half a dozen locations across Europe, and the existence of a free port in a particular location is one of the factors that makes them decide to go there, in the same way that existing regional development grants are key to getting people like Nissan to locate their factory in Sunderland rather than Valencia.
I think just on the point of free ports, and interestingly, apparently they can be as big as they can be 27 miles wide.
Yes,
Apparently, free ports. It's quite large. I'll defer to Geraint's greater age and experience as to the validity of and the working ability of these things. But I think a point has just come in on the chat about the redistribution of potential redistribution of jobs and economic activity that these will hopefully result in. I think that's a point I quite like as well. I think that yes, investment's going to be made. Is it going to be made anyway? Well, possibly, but when it is made in those places, other things come with it. And it is an unquestionable fact that the wealth and economic activity in this country is biased towards the southeast of England.
I don't disagree with that. The only comment I would say is, and this comes from my personal experience of working for what best part of a decade in South Wales, is that those sort of regional incentive grants, what they create is a very unusual economy. So, one of the economists I used to work with back then described South Wales as the land of the subsidiary company. So yes, you've got a big manufacturing plant, but the management, the senior high paid jobs don't necessarily move with that production facility. And the other thing is that investment can be relatively short lived. If somebody's decided to put their production plant in a particular location because there's a particular incentive to do so, they're not necessarily embedded in the local economy in the same way as, a long-standing family-owned business is.
Very true.
So I think in summation, they potentially do provide opportunities to the construction and the real estate industry where there's going to be some movement. Whether or not in the long term it's a good thing for the country and the regions is a different question. But yes, undeniably opportunities for some of our clients and contacts. So we've discussed some of the more kind of high level things now and sort of stayed away from the tax for large parts. So let's get back into the more nitty gritty and the stuff that we have to deal with on a day to day. As we've already said, the most significant rise, if the only rise really, other than the what's described as stealth taxes of freezing some of the allowances, was corporation tax, which is set to go up to 25% in 2 years' time, which was probably a little higher than what I expected. And I probably expected to see a bit more of a progressive route up to a higher rate rather than a couple of years free and then a cliff edge. So it shows what I know. But that 25% isn't applying to all. Only businesses with profits above 250,000, which is still a relatively small number, will pay the 25%. Those with profits between 250,000 and 50k will use a tapered rate, the tapering calculation yet to be disclosed. And the profits of less than £50,000 will be taxed at 19%. And if I've understood the rules correctly, and Mark will correct me on this, it's effectively wherever your profits sit, that's the rate you pay, rather than you pay 19% on the first 50 and then up there. So if you unfortunately fall above the £250,000 line, then you're going to pay 25%. So very much aimed at the bigger businesses. Aimed at the businesses that potentially have done reasonably well in the pandemic, the likes of the Amazons, if they can get the profits to actually sit in the UK as opposed to going offshore. And that's where they put their marker, and they've tried to make it easier, or at least not make things harder on small business. However, for some in the development sphere of property, that might not look particularly great, because if you have a development that takes several years to build up, and all of your profits actually fall in that final year when you eventually sell it, you could easily land yourself in that 25% rate, whereas a normal trading business making the same profits over 3 years may actually be down into the 19 or tapered rate. So Mark, can you just give us a little bit more or expand and commentary on that corporation tax change, why you think they've approached it this way, and how you think it pertains to the real estate in industry and businesses, and what they should be thinking about in their future planning?
Yeah, quite a wide question, mate. Yeah, I think in terms of why there's been a rise in corporation tax, politically you've got to do something. You've got you know, disregarding what I said earlier about all tax rises being largely pointless at the moment, you've got to do something, and taxing companies which have made a profit, and I think that's the crucial point to make here, that people and entities who have made a profit can contribute. And one of the easiest things to do is change the rate of corporation tax, especially when you start from quite a low base. So this is one of the sort of things in the ammunition box that the Chancellor had that he could mess with, because it comes from quite a low position. Taking the CT rate to 25% is still one of the lowest in the G20. So yeah, is it a bad thing? Well, clearly companies are going to pay more tax, so it depends on your view of that. Is it out of kilter with the rest of the world? No, definitely not. As to direct implications for the real estate sector, I think it's a good one you made there, Guy, in terms of how development profits may or may not fall. It's difficult to think of anything else specific, I think to the sector. Although it is worth mentioning that, and stop me, Guy, if you plan to talk about this in a moment, but it is worth mentioning perhaps the other things that have been introduced with regard to corporation tax. So, as well as looking to tax those that have made profits to a high degree, and that doesn't come in until April 2023, just to be clear. As well as doing that, we've also got an announcement whereby losses for businesses that have made losses can carry those back, instead of 1 year as currently, for 3 years. So an acceptance that while some have made profits, some haven't, and for those that haven't, it is reasonable for them to be able to take those significant losses, if they have made them, back further against their taxable income in the past. We've also got this new thing being introduced called a super deduction. Anyone on the call, well, hopefully some people on the call are familiar with the concept of capital allowances. Basically a tax deduction you can claim for money you spend on plant and machinery you use in your business. So if you're a construction company, for example, you're going to have tons of plant on which you are claiming tax relief against your current year profits for investment you've made in capital assets. At the moment, there is that's fed through on the drip, effectively a tax-approved form of depreciation. What we're going to have now for a period of time is this, as it's being termed, super deduction, which essentially says for anything you spend on qualifying plant, you will be able to claim a tax deduction of 130% of that number against your taxable profits. So for the right plant intensive business that is still making profit and can afford to spend this money, that's a good announcement, I think. Relatively, bundle all these things together, do they make much of a difference? Going back to the point I made at the very start, not really, but they follow the theme of trying to incentivize growth and trying to tax where it is appropriate. I mean, just as a final point on that, corporation tax as a percentage of the total tax take in the UK is somewhere around the 5% mark. So it's not a big contributor to our circa 800 billion of tax receipts a year.
And just running back to that losses point, do we know from the paperwork that we've seen so far when that actual when that ability to carry back will come in? So, for example, if a business makes a loss in 2021, for example, are they going to be able to carry that back 3 years, or is it going to be further down the line when they'll be able to kick that in, or do we not know yet? That's
a good question. We, being the royal we, may know. I don't. So I think that's something we can follow up perhaps after the webinar. My reading of the legislation almost implied that you could carry back 2 this year, which infers that actually it's losses in future years that you may be able to carry back. So it's a little bit unclear at this moment in time, I think, on that. And just talking about that corporation tax rise, obviously you've got businesses that may operate through groups of companies where the individual companies themselves
don't add up to a significant sum of profit in their own right, but together they do. And equally, you may have businesses that operate with what we would call sister companies that aren't in a formal group. How would you expect that corporation tax rate to work for those kind of structures that people may think, well, this is a neat way of getting around that?
Yeah, I mean, that unfortunately won't work. I think the limits and restrictions on these new measures, the beneficial ones, will be applied such that you basically share the allowance across connected groups. Possibly not with sister companies that aren't in a corporate group, but again, the devil on these sorts of things is in the detail, and it's probably worth observing. And this is only probably of interest to the tax geeks on the call, of which I suspect I'm the only one. That the finance bill, the thing that will legislate all of what was announced yesterday, has not yet been published. We expect that on the 11th of March. So ask me again in a couple of weeks and we'll probably be able to answer a lot of these questions a lot better.
I think while we're on the subject of corporate taxation, it might be worth picking up on what isn't, or what one of the things that wasn't in the budget is any form of digital tax, in terms of trying to tax the profits of those digital companies like Amazon, for example, who have done very well in the lockdown and traditionally have been, let's use the word adept, shall we, at locating their global profits in low tax environments. Personally speaking, I think something along those lines is coming on down the track. Frankly, it's something that needs to be handled at an international level rather than a state level. What is perhaps interesting and indicative of the direction of travel here is that hidden within the depths of the Brexit legislation are some legislation around the VAT treatment of digital platforms, which in effect require those digital platforms to account for VAT on the sales being made by their by their overseas suppliers, so the actual vendors, if you like. Now, I see that perhaps as something of a backdoor way for a state like the United Kingdom to collect for the first time some meaningful data on the volume or value of sales undertaken by Amazon in the UK and the likes of similar platforms, which gives them the basis for an ad valorem tax, basically not tax by reference to profits, but tax by reference to the value of sales, in the same way that they've taxed online gaming to say, right, we're not even going to try and compute the profits. We'll simply stick to your income number. We know what your income number is in the UK, therefore we're going to charge 2% or whatever you as the sales tax on those income. I think something like that is coming.
Certainly thinking about the businesses that have particularly prospered in the during the pandemic would be an obvious way to raise some finance to pay for it.
Yeah, and it's not a secret that those digital companies like Google and Amazon and all the rest of them have become very adept at locating their corporate profits in relatively low taxation locations, and that a number of countries, not just the United Kingdom, have felt that their exchequer is being shortchanged. Let's use that word, shall we?
Just two comments on that. One specifically from a real estate and construction perspective. Those types of businesses, and indeed sort of things like distribution, supermarket, off-site suppliers, etc., we have seen a significant uptick in the last 18 months on the types of real estate that those entities require. So huge sheds, huge distribution centres. I suspect that is a theme that will continue. So as an asset class, given the way habits have shifted, that is a significant one, I think. And just to the point on, we're straying off topic, but I just can't not say this, just to the point on the sort of digital services taxes point, Geraint's absolutely right. You've got to act globally on this sort of stuff, because if you don't, then the countries where those companies are based or headquartered start to think very negatively about trade arrangements and trade agreements with the countries that decide to unilaterally tax those entities. So, you know, I couldn't possibly comment, but there's a country not a million miles away from here that's just left the world's biggest trading bloc and is now riding high by itself, doesn't necessarily want to annoy someone like the United States, where a lot of these companies originate from. So it's a definite piece that needs a lot of work, but that won't be easy. Anyway, Guy, back to you.
Indeed, it's a bit more of a political point in a lot of ways, because the companies themselves are unlikely to exit a market just because we stick a little bit of extra tax on them, because it's such a big market that they can access, that they're still going to make a lot of money from it. But as you say, the trade agreements between the countries, that's a different story and may cause a bit of problems. So thank you very much to the attendee who raised that question, very pertinent question, and one that probably we would have all liked to have seen in the budget as a way to refinance, but it's not there yet, and hopefully one day it comes. So on to Grant's particular specialism, VAT, which is particularly relevant to the real estate world, given that there's 3 potential rates to apply there, or 4, I suppose, if you count exempts within that. And actually, there wasn't much in the way of changes to VAT, if anything, in this budget. There was some, at least in relation to the real estate sector, there were some extensions to the reduced rates for hospitality, but otherwise not much change. But the Chancellor did say something that was relatively ominous. He confirmed that he would freeze the VAT registration threshold until 23-24 at its present level of around about 85,000. And then he specifically highlighted that it was a generous threshold by comparison to other countries, which seems to put a bit of a target on that for the future beyond 23-24. Garan, what do you think about that? And do you think it's likely that that's going to get adjusted? And do you think, what will that impact have on the real estate industry, especially given that, unfortunately, the domestic reverse charge for construction services was not canned and it is in force now?
The UK, I mean, first of all, yes, the UK does have a relatively generous VAT registration threshold. So if you look at the VAT systems across Europe, on which ours is still very closely based, ours is the highest registration threshold by probably about 40 or 50,000, with Ireland being the next highest after us, and lots of countries in effect have registration thresholds which are, you know, 0 or very close to 0. Having said that, for as long as I can remember, I mean, I've been doing VAT for almost 35 years now, which is quite a sad admission to make. The consistent view from within HMRC has been that lowering the VAT registration threshold will not produce significant additional sums of revenue and is relatively expensive tax to collect, because you're talking about a large volume of unsophisticated taxpayers. So, you know, anecdotally, I always recall that some years ago, one of the comments was that the two cheapest taxes in the country for the Chancellor to collect are SDLT, which probably Mark won't like to hear, but you know, basically it's an almost nil admin tax to collect as far as the revenue is concerned. And surprisingly, airline passenger duty, because the only people who pay it are airlines, and there's a couple of dozen taxpayers, therefore, for HMRC to look after, all of whom pay large amounts of tax. I think it's possible as a revenue generating approach. I'm not sure how much it'll produce, though. From the construction and development industry's perspective, obviously, what it would see is perhaps an increase in the volume of sort of labour-only subcontractors who are required to register for VAT, and perhaps the introduction of the domestic reverse charge, which would take away a significant amount of their admin, if you like, would facilitate that. I'm not convinced that a major reduction in the VAT registration threshold will be of great assistance. although some years ago there was a report by one of the tax think tanks who felt that it would be significantly assist tax compliance in certain industries, and construction was actually highlighted as one of those where basically making everybody register for VAT pretty much from day one was something that would assist with tax compliance. Who knows?
And they did spend a bit of time talking about the amount of investment they're going to put into ensuring tax compliance and hunting down of those that have misused some of the schemes that the government has done. So there could be an angle there.
Yeah.
And equally, I suppose it could have been a relatively easy, positive message to say without anything behind it, just to sound like they're saying a positive message.
Indeed. I think coming back to, we are starting to see VAT being used as a tool of public policy. So in terms of things like the zero rating of digital publications, for example, and one or two of the other things that we're seeing it being used in that way to encourage certain behaviours or discourage certain behaviours. So it wouldn't surprise me that, harking back to something we talked about before, we may well see at some point an extension to the current reduced rates for certain property conversions, coming back to what you were talking about earlier, Guy, about repurposing assets. I think that may well be something we see perhaps in the next budget. But as you say, largely this time around, VAT has been left alone. It looks as if the headline rate is here to stay for a while. Obviously, leaving the EU does give us significantly more flexibility in terms of the rates we apply and what we apply it to. So, for example, there may be some changes on the exemption for certain types of residential letting to turn that into zero rated to produce more VAT recovery. I mean, prior to 1989, the UK had a much more benign environment for certain types of property development than it does now. There may well be some of that coming back in.
So it could very well be a tool yet to be played and let to be used, but maybe in the next few years that could come along.
Who knows?
So moving on to sort of final planned question, and probably the hot topic prior to the budget, which actually didn't really feature at all in the budget, and that was capital gains tax. There was lots of talk leading up to the budget about the potential for capital gains tax rates to be aligned with income tax rates. Indeed, I must confess that I saw that as a relatively easy way to raise some revenue, given that the types of people who generally pay CGT are unlikely to vote for the other side, even if that tax was put in place. It generally speaking doesn't affect the vast majority of the population. So it seemed like a fairly easy target there. But there was really nothing. There was simply a freezing of the annual allowance, which is relatively low anyway and relatively inconsequential in the grand scheme of things. So it wasn't a tax, it was left alone. So Mark, do you think that's a sign that the Conservatives are saying CGT rates are safe, they want to maintain things as they are? Or do you think that do you think that maybe actually the goal has been achieved in that there was so much talk and so many people perhaps enacted transactions to crystallise CGT at a rate that they could be sure of and fearing an increase, that the Chancellor can now hold this card back and play it down the line?
Yeah, yes. I mean, we as a business, as tax advisors, have probably over the last 3 or 4 months, particularly in the real estate investment space, have seen people who are likely to benefit from transactions involving real estate, capital transactions involving real estate, personally push whatever levers they can to advance deals that are already perhaps in the pipeline. So, and I absolutely know that that's also been true in the more corporate market where sales of companies have been transacting. We as a business worked extremely hard on a lot of transactions up until sort of 24 hours ago to get them over the line because of what was foretold. Well, foretold is probably a bit strong. And The issue came around as a result of essentially a report that was undertaken by the Office of Tax Simplification, the OTS, which basically came out and said, we think that their capital gains tax is totally right for reform, and basically the best way to reform it is just to make it the same as income tax. Now I'm paraphrasing it massively and shortening it there, but that's essentially what it said. And that the OTS is run by some pretty decent guys. They know what they're talking about, and the OTS is an instrument of government, and therefore people naturally assumed, well, if this is what the OTS are recommending, Chancellor's probably going to do it. They didn't, as you say, and there was no mention of it. So I don't think that's a good thing. Going back to what I said at the start, again, what's the point, frankly? Whilst people are not going to perhaps change who they vote for, they might very well change where they live. And that is something that we do not want. We do not. And this is not so much in the real estate sector, because real estate is generally taxed on the basis of where it is. And if it's in the UK, it's taxed. But you start messing with capital gains tax rates significantly, and you start, I think, to put the brakes on people wanting to build businesses and realise them in the United Kingdom. It's probably only a marginal thing, but marginal gains are what we are looking for at the moment. And the last thing I would say, again, going back to the sort of macro position, even if, I can't remember the precise number, but even if CGT was topped out at sort of current levels of income tax, and that didn't stop transactions proceeding, which would have otherwise proceeded, it would only raise circa 14 billion a year. 14 billion sounds like a lot. Context of the numbers we're dealing with, it's a rounding error, frankly. So yeah, I'm not entirely surprised and quite pleased that it wasn't touched, in summary.
So actually those fears maybe not too, or maybe a bit unfounded, and actually CGT may be here to stay in its present form, which perhaps a lot of people will be quite pleased with. I mean,
there are certain asset classes which, if I was in government, I would tax more strongly, but I'm not, and therefore I won't make any further comment. But there are things you could do which I think would be acceptable. But I'm not going to make any suggestions on this call because I don't know who's necessarily listening.
So that's all our planned questions, and we're getting towards the end of our time now. So I'm going to keep the Q&A session quite short. But if anybody has asked a question that we haven't answered, please do feel free to email myself, Mark, or Grant, and we'll be happy to try and answer those questions to you. There's two questions that I want to just put to the panel, two very simple ones. The first one I'm going to put to Mark, which is just about SDLT, just a clarification. Will the SDLT above 500,000 be the current reduced rates or revert to full amount? And I think the question there is, with the reduction, with the holiday of the 0%, has that dragged down the rates above 500, or have they stayed?
Just extended the zero rate there.
Indeed. So ultimately, if you're above 500,000, you're paying the same tax as you always were. It's just that the value below £500,000 is at 0% for the time being, until the 1st of July, where it goes down to 250,000. And then last one, there was a point about the free ports, which I want to just again put to Grant, a bit of an expansion of what he's already told us, really. Are there new free ports? The new enterprise zones in the 1980s? So are they the same thing? And will these not impact on the success of the adjoining areas, which will share the benefits? So I think that's just a bit more commentary on how the wider area around the Freeport could benefit. So, for example, could more housing be put there because there's actually more people in that?
First of all, I'd like to congratulate the questioner for the length of his or her memory. But yes, in some respects, they are very similar to those enterprise zones. And one of the aspects of those was the potential for what was at the time delightfully described as spillover development, which, as you say, Guy, was perhaps residential development in adjoining locations, or even certain types of commercial development for things like first and second tier suppliers, sort of just outside the borders of those enterprise zones. And I suspect, yes, that will happen. The extent to which it happens is obviously dependent on a mixture of the geography of the particular free port and the success of the free port. I think it comes back to the fundamental point, or if what we're trying to do here is to grow our way out of a very difficult economic environment, then those free ports have to deliver new investments. Whilst there may be a political desire to redistribute existing wealth across the United Kingdom and move investment out to the southeast of England, that doesn't make the pie any bigger. It simply moves where the pie is located. So the free ports will need to show their worth, not by simply moving investment from location A to location B, but rather by encouraging new investment. And yes, realistically, if they encourage new investment, then people have got to live somewhere, people have got to buy their shopping somewhere, etc., and that investment will come.
Indeed. So something to keep an eye on. So given where we are with time, I'm going to bring the Q&A to a close there. Apologies that we only got to get through a couple, but we did answer a few questions along the way, so we got a few in there. I hope that you found today's session useful and feel better informed. As Mark said, we haven't seen all the detail yet. They've still got to publish some of that stuff, so there might be more to say in the fullness of time. But ultimately, the message from the government is we are going to grow our way out of this. We're not going to tax you too much at this moment in time. But I think the taxes probably will come a little bit more in, later on, but perhaps not to a massive extent, because as Mark says, that's not the way out of this. We have to grow our way out of it. So again, if there's anything that anybody would like to ask, or indeed need help on, need advice on, need to do some planning around the corporation tax rise, please do reach out to us. Email myself, Mark, or Grant, or indeed your normal contact at Moore Kingston Smith, and we'll be happy to help. And I think with that, I'm going to close the webinar down and say goodbye. Best of luck, everybody.